So if you do need to go to the bathroom, you will need a pass to get back in, and it's just where the lift side down to the bathroom. Online. So thank you everybody for joining. Thank you for joining online. And Ray's just popped out, but thank you so much to Zurich for letting us use their facilities today. So we'll have everything will be catered up here as well. So if you're online and you missed out, that's come in person next time. So there's a fair bit for me to go through today, and there's some kind of interactive session after morning tea. We've got Rochelle here from Main Street. Rochelle's a practice manager at Main Street down in Hobart. She's going to talk to us about AI in practice. So similar to what we had some presenters in November going through, Rochelle's going to cover off on some of the AI that they've adopted in their practice. We'll go through some ethics. So I know people have been calling out for ethics sessions. I'm trying to make it not boring. So this one's an interactive session, so we'll split you up. Those online, I'll have a chat to you online, and we'll go through a couple of case scenarios with each group. After lunch, we're going to have Ray and Kiralee from Zurich having a couple of sessions about performance anxiety from a market perspective, and the cost of care white paper volume 2 that they've released. For insurance. And then we're going to have Kate for his last act. So if for those of you who don't know, I'm not sure if you don't know, Kate has officially retired. Yep. But he keeps coming back to do PD days. So if you this will be his last PD day for us. Yep. Right now that we know of. Yeah. So we'll just stay tuned.
Wait till see after the budget.
Yeah. All right. So kicking off into some updates from our perspective, from a dealer perspective, there is quite a bit to take in today. General advice warnings. So please come and talk to me before you take action on things. That's a little bit of a timetable. So we're going to talk a little bit about the delivering better financial outcomes, which what's going on with that and where are we at. ASIC's key issues outlook. So this is different to their regulatory outlook that we had a look at in November. I'm going to have a look at ASIC and particularly focusing on SMSF establishment. There's also been a legislative review on the wholesale clients, sophisticated clients. There are more changes coming up about advisor qualifications, which you'll all be very happy about. And even worse is the continuing rising compensation scheme of last resort. So we'll just have a quick touch on those things. They're not very exciting. I'm so sorry that I'm always the bearer of bad news. I'm so sorry. So this one's a little smaller. I don't know how I can change that screen. But basically what's happening with the Delivering Better Financial Outcomes Act. So we've removed FDSs. So from the 10th of January, we're in this phase now where we don't have to issue FDSs unless they were due, the anniversary date was before the 10th of January. Okay, so we're still in that 120 days to get the document out to the clients. So if there was anybody who was due an anniversary date before the 10th of January, so right up to the 9th of January, you still have to issue that FDS. It's still a legal requirement. There are, and we've already seen some teething issues with the product providers, dates of consent forms. Their systems aren't yet set up to be able to accept a few of them. A number of them already have the facility to do this, but there are some that have lagged in terms of being able to accept consent forms 60 days prior to the reference date. So be aware of that when you're talking to clients, when you're getting them to sign documents. I've had Netwealth confirm that they will accept our fee consent form, so our ongoing consent form. But again, you need to check with the product providers to make sure that they accept. So I'm getting some mixed messages from some of them. So do your due diligence, make sure you know what you need to provide to those and the timing of that. Tranche 2, now this is really interesting. We're coming up to the federal election. Instead of kind of pushing forward with things, Minister Jones has resigned. And everything's kind of, there's very light little talking about bits and pieces. There's a big focus on compensation scheme of last resort, as there should be at the moment, and the escalating costs there. So it seems a lot of energy is going into that. But what they're bringing out in tranche 2 now, Mr. Jones has said that he expects to release some draft legislation before the election. When's the election, Rocky?
So
They haven't announced it.
before May.
Yeah, I don't think they have an update.
No, they're talking the next few days.
Yeah. So it's not, they say that they're working on it, but it'll be interesting to see what comes out of that. Now, they're introducing a new class of advisor. They don't know what to call them yet. So at the moment, they're called NCAs.
Advanced advisor.
So what they're actually looking at, well, they've changed their tact on this a little bit. So previously it was that these were people who had to have a basic RG 146 and could provide basic advice. They're looking at this being almost a stepping stone for financial advisors in their career. So you start kind of at this level, you progress with your PY, then you kind of step through. It's like they've changed tact on that a little bit. It'll be interesting to see how they come out on that. It's supposed to be just the guidance on selecting insurance policies and basic retirement planning. We'll see how far the scope creeps.
Who's it targeted for, do you think, really?
It's for
Product providers. Yeah.
mostly super funds. So being able to help clients, and we saw this blow up with Westpac in particular, where they had, there was a lot of, they would call clients and get information about them and say, this is just general information, general advice. We're not giving you personal advice. We think you should stay here, or you should consolidate your super into this fund. So they were reprimanded quite severely for that. But we now have this kind of almost the legislation going, oh, well, maybe that was a good idea. I don't know what will come of that. It's a space to watch. Tranche 2 also includes the modernisation of the best interest duty. So this is clarifying, and we've had this argument in the industry for a very long time about, can I give specific advice in scoping and making sure, the client doesn't need comprehensive advice. Their main focus at the moment is just this element. They need to get through that. If I give them comprehensive advice, it can be overwhelming. So we're taking it piece by piece. That's always been part of scoping. But it's interesting they're saying that they don't feel like that wasn't clear enough. So the modernisation of best interest includes that clarity about being able to offer advice on single or limited issues where it aligns with the client's needs. And the removal of the safe harbour steps. So you still have the best interest duty. They're just saying you don't have to have this prescriptive checklist about, have I got this, have I got this, have I got this. You'll still do it anyway, to be honest, like loosely behind the scenes, probably not even loosely. Have I done all the things I need to do? Right, so it's just not as prescriptive as it has been. And then we look at the simplification of advice documentation. So looking at how that can be more consumer friendly. I'm really not sure how they're going to come out with this and what they're saying they will accept as being able to be taken out. That will be interesting what the legislation actually says itself. I know behind the scenes with Insignia Alliances, they've got some documentation that they're working on pushing through, which is a simplification of the SOAs. but I know a couple of the groups are also working on SOA simplification too. So if you want to work on some of that, I'm happy to. Our limitation right now is if you're generating advice documents through Xplain, it's very costly to get them to redo and develop our own templates through that, which is why we've used Insignia. But let's have a chat. And then we've got that enhancing the super fund engagement. So, which is what we spoke about before a little bit with the NCAs. So this is that the reforms will permit super funds. I love this wording, right? To provide proactive guidance or nudges to members at pivotal life stages. So promoting better engagement and decision making. So I'm not quite sure what that actually they're looking at in that, whether that's like notification to clients about, hey, you're coming up to this stage of life, you're coming up to this age, have you considered these things? But apparently they can do a little bit more as general advice. So again, another interesting space. What they're trying to do in essence is build back the advice community. So we've lost so many financial advisors. They're trying to understand where they can bolster advisor numbers and accessibility for advice to clients.
My uninformed comment would be that that's largely directed towards enhancing the capabilities of the industry and corporate super funds.
Mm.
And nothing to do with us.
Even some of the other larger corps, like how they have these selected investment options, lifestyle, life cycle stages.
Yeah.
As soon as you reach this age, you just automatically in that fund.
Yeah.
Yeah. Pay.
Yes. So
it already occurs.
Yeah. And it'll be interesting to see what that actually pulls out of what that will look like, and how they will enhance that engagement with clients. It's bordering on, there's a very fine line about, is this advice or is this not, right? So remembering the definition of advice, does anybody know it? Quickly.
You'll tell us.
Sorry?
You'll tell us.
I'll
Specific to a client, it's tailored to them.
to a client, but it's even simpler than that. Financial advice, is any statement meant to influence a client either to do or not to do something? It's as simple as that, right? If I've discussed something with a client and told them about this strategy, and then the client comes to me 2 months later, have I given advice? Well, I kind of have, because I've influenced them to make those decisions, right? Yeah. So that'll be really interesting to see what comes out of that. I made these too small. I'm so sorry. My computer, these look very big. So I want to talk about the key issues outlook for ASIC. They've just released this a month ago. So they've got a very big focus about superannuation, advice. Sorry, coffee's been delivered. And how clients have been set up with SMSFs, etc. One of their other focuses is the dynamics between public and private markets. I'm not sure if you've seen any of the media articles at the moment where ASIC is actually warning that they think that there could be some real problems with the private credit market, and they're expecting a lot of failures in that area. So this is, I know that there's a couple of advisors within our group who have looked at private credit and have recommended some investment in those. This is a space that you really need to make sure that you've got lots of due diligence, that you've got lots of documentation, that you've really done your research. ASIC really coming back and saying that they think that a number of the clients, so they've already had some complaints that their clients have been invested too aggressively. So be aware of that. ASIC will probably put some more kind of gold restrictions in place about that, but they've certainly highlighted it as an issue that they're looking into this year.
What if they got good returns?
Won't be an issue.
State
That's what they're saying they're going to give.
It doesn't matter when the whole.
Keywords, state mortgage.
It's all the new operators that are just coming online that's the issue, because you know, like people that have been established and doing it for a long time get the best deals, and then
The issue is there's only so many deals that can be done, and if
Yes.
more money flows into it, they've got to be doing it somewhere.
Yeah.
They don't say no to the new farm, and then
Yeah.
the quality goes down and
Yeah, so this is the thing, you need to be aware of it, make sure your documentation is very comprehensive. And you've got some great research behind that and justification. So, you know, it's great to have, and you need to have all of your documentation to say, I've looked at these reports, but your thought process on how you got to make that decision is really invaluable. I've had a chat with a couple of advisors. You know, we've started recording client meetings, which is great to get the transcript and then the file notes out of that. But the thought then is, do we then progress that to you sitting down with your computer open, Teams recording, and just verbalizing, here, I'm looking at this document here, and this is what I'm thinking for this client, and this is why I'm not considering this, then I can see this and I can do this. Is that the next step? So something to think about, how you're recording your thought process on how you actually developed that strategy and selected those products, rather than scribbling it out on a piece of paper. One of the other items that they've identified is super members being let down by their fund and trustees. So this is really aimed at the funds, but they've got a real focus, as I said before, on super with clients, because the complaints have doubled. Right, between 21 and 2023, the complaints have doubled, and I expect it more. We've got more money now in that retirement space as well. So when we see complaints, it really comes down to clients feel that they haven't been heard. They feel that they've been invested too aggressively in most cases in complaints that we see. They think that the products were inappropriate, right? So again, your documentation is really valuable here.
a lot of this that would be solved if there was standardization around risk profiling and what a balanced fund is.
I think standardization around what are these, yeah. You know, what is a balanced fund?
Even just to make a complaint, how there's no ties on that person to make a complaint, literally.
Yeah.
Like, make a complaint.
Yeah.
See what I can get.
And there are people out there who are making a business out of encouraging clients to make complaints.
Other advisors.
Other advisors.
Why though? Because again, like, there's no responsibility, there's no accountability
It's just uphold.
in making a complaint.
You're supposed to uphold your profession, and they will argue that they're doing just that, right? So I've seen that there's some advice that these clients got that I think was inappropriate. So there's been real discussion about if any of you have been through the AFCA complaints process. AFCA do this with financial planning. AFCA do this but-for scenario, right? So they go, if the client didn't seek your advice, they would have stayed in the product that they had, and this is where they would have been in that product. Now, it's I think it's a very unfair assessment, because they're saying that the clients would have done nothing.
What they didn't make their risk profile as well. So you're doing a growth fund, you should need a growth.
No,
fund.
so we've gone through this a number of times with AFCA, that they will go, it doesn't matter, and they will pick the fund that they think, you know, if that fund has closed, they'll go, okay, well, or close to new members or whatever it may be, they'll go, who was it last time? CFS balanced. We think that that's probably an indicator of the market. So that's what we'll assess it against. So if they had kept their funds, if they had their funds in CFS balance, this is what they would have had at the end of the
Do
day.
they only measure net return, or do they measure like bold? Like, what metrics do they use?
They don't know.
Depends on the case manager. Depends on the case manager.
Absolutely not logical at all, Nick. Not logical at all, and are not required to follow any legal precedent or anything like that. They can make up the rules as they go along.
Even the client sensitivity on, like, just to add on what Nick said on the volatility side of things, that client that I spoke to you yesterday about, no,
No, I'm really conservative, but I want 6 to 8% at least every year.
Well, that's in
I don't
conflict.
want my money to go down.
Yeah.
I'd rather just like, if I can cash it out, cash it out. But, 6 to 8%, that's what I would expect. So,
Because they're not, they have no concept.
no,
So it comes back to your comment about risk profiling. You give someone a risk profile questionnaire, everyone gets into the balanced category because they all seem to answer the same, but it doesn't go into the nuances of.
Yeah.
So
The question
we've
is
had this
not-
conversation for a long time. How do we have a systematic approach to managing this issue as a team, as integrity?
We should be recommending their risk
It's our job.
profile, is my opinion. As an advisor, we should be recommending it based on what their goals are. This is what we need
I just
to live
talk to
on.
my
This is what we
discussion, yeah.
want to achieve. These are all this. Okay, well, here's the risk that you should be, or do you need to take to get that? Or if you don't need to take as much risk, let's pull it back. That's
Might have to pull DB up for a bit of a session on risk profiling and how he has done it in the past. But they have a
No, but I've been asked for a questionnaire from CJ, and it's like, well, as in document.
yep. So it doesn't need to be. So we use the terminology questionnaire, but if you've got discussion points about what you've discussed with the client, how the client has reacted, why you've classified a client that way, a risk profile questionnaire is not actually a legislative requirement. Right? The legislative requirement is that you conduct risk profiling on the client and you determine their risk appetite. But in that, you need to ensure that the clients do understand what you're saying.
It's not just volatility, it's like liquidity risk, inflation, like it's more than one. Everyone just looks at longevity risk. So that's what I go through and say,
Yeah.
well, you've got 7+ years, so your ability to take on volatility is high.
Yeah.
But you need to beat inflation, etc., and that's what you document. And
Yeah.
but you're not willing to see your money go down.
well, that's our
This
job.
is
That's
where
our
you're
job to
identifying.
educate them. That's right. Yeah. So we can identify them if this is what they need to invest in and explain why. But if they say, I don't want this characteristic, well, then that's them just not accepting your advice.
So
Based
that's
upon
why
your
I guess
assessment of their risk.
That client yesterday,
10%.
can they give you an answer as to where they can get 6 to 8%?
No way.
No, they can't tell you, can they?
That's our job then. So like,
That's right. And I actually support that idea that Nick and Matthew have just raised, because you think about other professionals, we want to be regarded as professionals. We go to see a lawyer or an accountant, we put our situation on the table. They come back with a recommended structure or whatever. You go to see a doctor, we've got no idea what the medication is. The doctor recommends what they think we should take, so they're providing the advice as to what they believe is appropriate to our circumstances. And in the same way, we listen to the client and we're weighing up their goals and objectives and aspirations, et cetera, and part of it will be incumbent upon us because they have no idea. And it's further exacerbated by the fact that, as somebody mentioned before, there is no homogenous labelling out there. So what we describe as balance is very different if you go to CBUS.
And perfect example is clients I saw the other day calling themselves conservative
Yes.
and looked at their asset allocation and they're in balanced portfolios.
So what does conservative mean for the client?
Exactly.
What does that
And
mean?
going into that and talking about volatility and risk and.
I used to factor it into my actual, discussion with clients. My dad described himself as conservative, but his definition of conservatism was not running out of money. So that was the risk he was trying to avoid. When you actually, investigated what he meant by being
They're not going
conservative,
to lose money.
he did not want to run out of money.
Yeah.
that least you do for every client, Paula, is
Yeah, and
diversify, like just educating clients on diversification. That's like the core risk mitigation and profiling. You're basically saying we're recommending you invest in these asset classes, different investments, and that's how we're managing risk. Because if we put your 100 grand into one equity, that's more risky than spreading it across.
yeah,
different
and this is the
areas.
whole
That's-
reason I'm here today, because this is what we do. We have this little asset matrix that we always talk about, and we go through you know, which assets, four assets, you know, cash, income, cash, term deposits or whatever, property and shares. And we talk about income versus growth
yeah.
versus inflation.
Yeah, so you're
versus
doing that.
time. And time is risk is a function of time, etc.
So just documenting that conversation.
Yeah,
Just,
exactly.
yeah, if you just document that
Well,
conversation, then that's
I
done.
always do scribbles and then I scan it and then attach it. But yeah,
Yeah, if you just, that's exactly what I do. If
Yeah.
you just record that conversation as a risk profiling file note, that's how you come up with how you.
And a lot of the time, you wouldn't need, like, you could have that conversation and then you might need to then go back and then start looking at your modeling software and things like that to go, okay, well, they're saying they're conservative, then they don't want to take risks. Okay, what does it actually look like if they were going to get a return profile of 5% per annum? Okay, well, actually, they're going to run out of money. So what does it look like if they're going to get 7 or 8% per annum? So what does it,
Yeah,
so
longevity.
again, like that's when you're stringing out. And that's after a meeting. Like, you can't give them the answers right then and there.
These were those questionnaires, like you said, if they fill it out conservatively, you've then got to document
why
a big
Yeah.
change from
Yeah,
here to here.
why
Whereas
this,
if you
yeah.
have the discussion and list their goals and risks and everything, you're sort of doing it all in one and you're doing it right the first time rather than getting them from here to here.
No, you're right. I mean, I think probably 4 of the people in the room here can vouch for this, but part of the conversation we used to have with clients was, well, okay, we've gone through this process with them where they try to identify, you know, their risk profile by way of allocating a pool of money to the various classes, okay? And then, you know, I'd summarise that by saying, well, okay, would you give us permission? We'll go and model this, but if this doesn't achieve your goals and objectives, will you be comfortable if we come back and recommend a slight, you know, a bit of a change to this that we think is going to be more attuned to achieving those goals and objectives? So you've sought that advice in advance, and people never say no.
I think the difficult thing is that people actually don't really pay much attention until the markets drop and they lose money. And then they're suddenly, I think I'm much more, I don't want to lose my money. I'm feeling really nervous.
Again, that's our job.
When
If we've done the right thing, then the market's
Yeah.
falling shouldn't impact their goals and objectives.
this is the thing, yeah, right. So, and it's you know, building that relationship with the client and that trust element of this is what a market does.
Myself as well, because of that, I'll do a questionnaire. I'll certainly do the questionnaire.
Yeah, I've got
And then
to
also do
that.
what Darren does as well and have it all sort of encompassing.
Yeah, Rochelle, what are you doing?
Capital preference.
I was going to say capital preferences. So Main Street have taken up capital preferences. So have Next Level. So capital preferences came and did a session with us last year, and
It was outside of the PD day, wasn't it? I think it was a special one, wasn't it?
she did a presentation session and one on a webinar online. So that's really looking more at client behavior, behavioral science. There's not too many questions specifically about investing, is there?
Yeah, so it only takes them about 2 minutes to go through. So we send them to the client, which takes them through 5 different scenarios of how much are they prepared to lose based on a figure, and those figures move, and they literally just change the bar between where their risk is, and that then comes out with a report, and it shows. So that is actually linked to our portfolios as to where they would be in that risk, and then if they come out where they're it may be a little bit dubious on some of their answers, they'll actually say you need to have that discussion with the
So
client.
it identifies where there's conflicting information and conflicting kind of positions for the client.
Yes, that's right. And then when you do then go through it with the client, it gives all of those different projections that you can then play with on the screen with the client and go through that whole process.
What's it called? Capital preferences. Now, just remember that risk profiling questionnaires are great to give a base, right? This should be the start of your conversation. Or it doesn't have to be the start, but it's a part of the conversation. It is not the whole conversation. It's not, you've completed that, so now you're this, right? It's let's educate you. Let's talk about what this means.
I think that's the hardest thing that Nick said, is that if they fill it out and it comes back as something, from an applicant perspective, like for you to then document and say, well, this is why we don't think you're a conservative investor, they're gonna say, well, this is what the client gave you. Like, what do you mean?
No. So
But-
I've had, through AFCAR where we've been able to go, this was the risk profile questionnaire, but this was the conversation that was had.
Mm.
Yeah, so they can be differing, but you have to have that documentation of those discussions. That's the key point.
Just another view, probably just to add on what DB said, is referring back to their living expenses and say, okay, well, we think we need this. And I always say and emphasize in my meetings, and I'm sure everyone else does, is we can't tell you how much you spend, but based on that and based on that risk profile that you have identified yourself as, say if it's conservative or balanced, this is when your funds are going to run out.
Yeah, so when
If you want them to run out, if you wanted to run out they said like one from a couple of weeks ago, is that I want the super funds to last 20 years. Based on this risk profiling, well then I'll show you how much your living expenses would need to be.
Yeah.
Okay, and I'm not telling you how much
Yeah.
to spend.
Yeah.
But sort of indirectly saying, if you reduce your living expenses by X to Y,
Yeah.
it will last 20 years. Well, higher,
Yeah, and
higher
that's a
chance,
great way.
higher
So
chance to last 20 years.
that's a great way of identifying, if you're wanting this outcome, this is what this needs to look like.
Yep, yeah.
What I see quite often in advice documents is, what clients do, they kind of lowball their living expenses. And then you go, oh, okay, well, it looks like you should have, an extra $20,000 a year in cash flow. So when I do audits, I'll ask, where's that $20,000 evidence where that $20,000 is?
Yeah.
So if your modelling is based on what they're saying is $20,000, but they're actually spending all of that, that's a massive impact.
Yeah, if I can make a comment on that, one that I picked up from DB as well is, okay, you said you're saving, 24 grand a year. So every month are you saving 2 grand? And then you catch up with them if it's a few months later, what's your bank account at? No, it's
Exactly.
it's just
Me,
if it's a new client, if it's a new client and say, no, you're saving 24 a year, yeah, that's about right, okay. So you saved about 2 grand in the past few months. Oh, no, we've had Christmas or this and that. Like, okay, so there's an excuse. So you're not.
Yeah, exactly.
Sometimes you have to be like,
Exactly.
I feel like I'm a little bit blunt in some of my meetings to
I'm so
those clients. Well, are you saying?
But you have to be. So because you need that information, right? So you have to base the information on the actuals, not what they would like in theory. And
Yes.
like
Do you
it.
do this every Christmas? Oh, yeah, I do.
Oh, yeah.
Well, then it's part of your living expense.
Yes.
Or do you,
Or is this a one-off? Yeah.
I literally say, I don't care what you spend your money on.
No.
Then the advice document that you're paying $3, $4, $5, whatever, $1,000 on is not relevant to you.
Yeah.
You want to pay it?
You don't mind. You don't mind.
Yeah. Yeah.
That's a really good point, explaining it to them in that manner. You're spending 45 grand on this advice document. Do you really want to give me information that's not correct?
Yeah.
Which means that this is a waste because you're never going to be able to do what I'm going to recommend because you're not giving me the right information. And it's a hard conversation, right? At times with clients, because finances are personal and people feel guilty. Well, I should have more, or I should have done something different. And it's a hard conversation. Great conversation that we've just had though. Really, really appreciate all of the input. With that issue there that we've got about funds being, super members being let down by their funds, one thing that I would say to you, and I thought I put it up, but I didn't, is this is having a look at those underperforming super funds. Okay, you've got clients who are invested in underperforming super funds. They're getting lots of notices, lots of information that, this is from the super funds. Yeah, it's a bit warm in here. Debbie's sussing it out.
So that valuation doesn't.
So be aware of that. Make sure that you are assessing those clients and that you have checked if it's an underperforming fund. This is an interesting one. I haven't had much experience with scams from a client perspective. but we've had one recently, which is quite interesting, about how financial advisors can be scooped up in this. Okay, so be aware of it. There's so many scams out there, they continue to evolve. There are so many vulnerable clients who are being taken for a ride. Be aware of it, educate your clients about scams. Be vigilant about clients who are repeatedly asking for withdrawals that are out of the usual. And take steps to check their reasoning is valid. We're going to go through some case studies later on, and I've covered part of this scenario. But you do have a duty of care where you notice something that's a little bit out of the ordinary. What we've learned is clients may not always be truthful, and they're maybe a bit embarrassed by the fact that they've got caught in a scam. It's a whole different psyche, right? So be aware of it, really question your clients. If you think it's a scam, take steps to help the client understand that it's a scam, right? Let's have a look at that email. Let's have a look at that information that you've got. Let me do some searches. ASIC ACCC have a scam website that you can go on and it'll list scams that have been reported. Report the scam, report it. Help the clients. It's a really scary area, really scary. Unsuitable super advice resulting in adverse consumer outcomes. So this is another area that ASIC are really looking into. What they're looking at in particular, and this is interesting that this has come about, they're having a real focus on property investments within super, and believing that there are high pressure sales tactics and social media targeting.
What type of properties investments are we talking, like REITs, direct property?
Direct property investments they've highlighted.
What platforms are they talking about? Like NetWealth or like just
They're
SMSF?
looking through SMSF, but they have made it quite broad. They are looking at how properties brokers are developing products. They could be unit trusts, they could be unlisted property trusts, all various elements, could be direct property. They are really having a look at this. If you have clients in SMSFs who have some sort of a property investment, have a look at it. If it's one that you haven't recommended, it needs to be very clear that you've never recommended it. You are not recommending it. You also have that obligation to have a look at it and go, I don't think it's appropriate for you. Now, a lot of those properties will be illiquid.
A lot of the issues come down to, like, for the retirees, if they've had the property for a while and it's grown, and then they've got certain drawdown requirements and things like that. So then they're either shifting back into accumulation because one, the property is too high and not producing enough income for them to actually take the minimum pension payments and things like that. So yeah, I don't know. This is different.
So I actually, in talking to a number of our advisors, there are very, very, very few recommending establishment of SMSFs. And a lot of you are recommending wind up of SMSFs. That gives me confidence that helps me sleep a little at night. But it's really important where you are. So ASIC are specifically targeting SMSF establishment. That doesn't mean that their scope won't kind of expand. But if you are recommending SMSFs, make sure that you have clear documentation. If you've got clients who currently have SMSFs, you also have that obligation when you're reviewing the client to make sure that the SMSF structure itself and those products are still appropriate to the client. Right, so you do have that obligation. That's what they're paying you to do. Yes, it's an SMSF. Yes, they are trustees. Yes, they're responsible. AFCA take a bit of a view about poor client scenario. should never have it.
That the SMSF's the financial product, so the property now becomes a financial product effectively.
Yeah,
Even though we don't see it that way, but for some reason.
no,
You can't tell them to buy or sell direct specific.
Yeah, but the SMSF's the
You don't-
financial
we
product.
don't have a license for property, right, for direct property. We don't have a license that covers that type of advice. Right, so, it's a structure. But it's a concern and it's something that ASIC are very focused on. The next element is the cyber attacks, data breaches, internal system failure, that's undermining, market confidence, so consumer confidence and causing financial loss. So ASIC are again, they're looking at operational resilience across the sector. We need to keep looking at cybersecurity, keep increasing our frameworks there, making sure that we are protecting client data, that we do have all those structures in place. ASIC will take enforcement action against entities that fail to meet their cybersecurity obligations. So that's first and foremost us, but you as well if you haven't got those structures in place. So making sure that you've got your comprehensive cybersecurity plan. You know, we've brought on board Cyber Collective. If you're not with the program, let's have a chat. Let's understand why. Let's see how we can resolve that gap for you. And all the training for the staff. You know, talk to some of the people who are using Cyber Collective and using that training and Cyberto. Funny to chat about. You have a bit of a laugh about Cyberto, but the thing is, you're talking about it, right? It's not meant to be a completely. You know, we play on that psychology of play, right? It's funny. It's something we remember rather than it being very, very serious and something that maybe we don't remember because it was boring. So bringing in this element of fun helps. So if you're not with the program, let's have a chat about it. Poor household outcomes following natural disasters. Now, this doesn't relate directly to us, but you may have clients who are in this situation. So the saying deficient claims handling by general insurers. Just try to help your clients. So educate them on the claims process, help them with complaints if they need to about their general insurer, encourage their financial preparedness. So talking to them about emergency savings to cover expenses while waiting for payouts. Looking at other kinds of coverage. They did mention income protection, but you'd be more looking at business continuity if they're business owners, etc. And that they should be reviewing their general insurance regularly. Now, we cannot advise on general insurance, but you should be identifying that with your clients. Do you have it? Do you think it's enough? What happens if there's a flood tomorrow? What happens? I was listening to the radio on the way in that over autumn they expect more fires in Victoria, like the fire season's not over. So, you know, all of those sorts of things. Floods in far north Queensland. And one side of the country is flooding, the other one's on fire. So welcome to Australia. But, you know, you do have a role to play there to help your clients if they've been affected. Is anybody aware of the ASX replacing CHESS?
Yes.
Yeah.
What income's closing?
Yeah. So just be aware of that. There is likely to be a little bit of pain points for clients with getting requests through, etc. But just it could cause some temporary disruptions. Just something to be aware of. Poor quality, climate-related financial disclosures relating to misinformed investment decisions. This is about greenwashing mostly. So again, it doesn't affect us directly, but it can affect some of our clients, and particularly those who have that ESG perspective that they're wanting to push with their investments, that they have that philosophy. Having a look that it's actually it's not greenwashing and that they're legitimate ESG. That's where your due diligence comes into play. Poor audit quality resulting in declining market confidences and misinformed investment decisions. This is about auditing of the products of those entities. I haven't got anything in this what to be aware of because it doesn't really affect us. It's very obtuse to us. And then this one, banks and lenders exacerbating consumer financial hardship. Nick, are you experiencing this within mortgage broking? The hardship is quite,
Yeah,
they can't, yeah.
no, I find it pretty,
Yeah.
so if you're proactive with the bank, they'll be
Okay.
good.
Oh, well, that's good to hear.
Yeah, the only issue, if you do nothing, they'll have no choice, but if you proactively reach out to them and they're
Yeah.
always, yeah.
Oh, great. So you've had some great experience. Okay,
Yeah,
good,
yeah.
good. So, ASIC are,
He only knows strong deals.
Yeah.
so they're monitoring there. They're saying that, it's quite difficult for, clients to claim hardship and to have some allowances there.
Clients that want to claim hardship that I recommend not to, because they don't actually need to claim hardship,
Yeah.
but the ones that do need to claim hardship, yeah, work through the
Mhm.
issue and.
Okay,
Yeah.
good. Okay, good. Well, that was
Want to claim it. but-
that was.
Well, yeah,
there's a lot-
exactly.
And there's a lot of issues there that ASIC are really looking at advisors for. Out of that, they have been doing some real work in the SMSF establishment section. They have already undertaken some reviews of SMSF establishment, so they're wanting to make sure that.
Is it retrospective? Are they going back in time to?
Yeah. I don't know how far back though. Now, I haven't heard from any of our advisors that they've been requested to provide documents to ASIC at all. So if you have, please let me know. We do have this, ASIC ask us as the licensee if they want us to be notified or the advisor of any regulatory action. So I've always put down the license so that we are aware and we can support you. But if you have got anything from ASIC about SMSF, let me know. They're looking at publishing in the second half of 2025. They're also looking at licensee oversight, their policies and procedures. So make sure you're across that as well within our
Is
policy.
it, so, Caroline, is this mainly for financial advice recommendations or is it even just trustees opening up their own self-managed super funds? So like, as an example, there's such a big focus on, hey, supers to provide you consistent income, in retirement, right? So you're building your retirement wealth. How many of the people that in the past 5 years have opened super funds because they've looked at the internet and seen that if they open up a self-managed super fund, they can invest on crypto?
Yeah. So,
Like there's so many uneducated people opening up self-managed super funds
absolutely.
for a quick kick.
Absolutely. What we have seen come out of AFCA is a very negative approach to financial advisors with clients who already have existing SMSFs and they come to the advisor. So their approach is you should have told the client that that was not a suitable vehicle for them. It should be in writing. You should be recommending that they wind it up. And black and white. It's not appropriate. Tell them to wind it up. Now, there are some clients who cannot wind it up because of the various
Yes.
liquidity issues, the various investments that they've got.
But then that should be the advice that you can't want.
Correct you. And that's what they expect to see rather than you've told me that you only want me, you've got an SMSF, but you only want me to look at this parcel of investments within that SMSF. Okay, so AFCA take the wider view that you should be looking at as part of the code of ethics, the broader client.
Oh, I just think that there should be a bit more like trustee regulation rather than.
Absolutely,
Again,
absolutely.
I don't know how you can monitor it, but if they're worried about property investments, like I'd be much more worried about crypto investments going into self-managed funds and things like this.
I think what they'll be focusing on this is looking at, and they're doing this with wholesale clients as well, looking at a tougher test for clients to go into SMSFs. Right. So that doesn't mean that the client can't have set that up outside and come to you. Right. But you need to go rather than accepting that they've got an SMSF. Now you're providing advice on that structure. you need to look at that structure and go, is that actually in your best interest?
Oh, it's just interesting, like every self-managed super fund has to have an investment strategy and everything like that. How many of them would just be, like, I'm just saying, like, purely
0 to 100%
Yeah, yeah,
for
yeah.
every.
0 to 100% on every asset class, or you've just got like one single asset, or you've got, again, like whether one single asset class, like it's, again, like you can't, I just think that like, rather than it always being advisors that are getting investigated, the trustees should be,
It should
some
be.
obligations, because if,
Because under the legislation, they are responsible, right? But now it's been flung back that, to the advisors that the client should have had that structure in the first place.
They don't have jurisdiction. over
no, I'm just saying, what about non-advised clients? That's all I'm
No.
saying.
You're advising the member, so.
Yeah, no, but I'm saying like, not even non-advised, like just people that go out and do it, like we're the ones that are always popping the flat, but like there'd be so many non-advised
There are,
members
there are.
that have got these super funds that are.
If you have a look historically, there are a number of SMSFs that were set up and these clients had no understanding of investing. They'd only ever had their super fund and they didn't know what was in that.
Mm.
But suddenly these clients have been assessed that they know what they're talking about and they can be trustees and they can run their own super fund. Like that's a huge gap, right? Like, oh, do you understand that you're actually running your own super fund? Do you know anything about investing? And that's where there needs to be more stringent testing and parameters in place for somebody to even establish an SMSF. So it'll be interesting to see again what comes out of that. The fact that they said that they're going to publish their report in the second half of 2025 to me indicates that they're already finished the review or they're close to finishing it for it to be published in the next 8 months.
Should be investigating. Garnets.
Are you able to? That's actually.
They should be.
race.
Yeah, no, I'm not saying that. I'm just saying like accountants should be like, you need an accountant, most of
So-
the established one, so like, I don't know why there's not. Should be a bit more scrutiny on that.
Assessing things like on a holistic basis. Probably just coming back to a couple of points, I had one client come in, they've purchased a residential property, well, they set up a submanaged super fund themselves, purchased a residential property, now can we set up some, satellite investments around? But we still got to look at things.
You still have to look at it and you go, do you know what? I actually think that that was probably not the best thing for you to do.
This one here was fine,
Yeah,
supposedly.
it's a
But we
really
don't-
fine line, right?
Sorry to interrupt, like that property that they were buying was in the business that they're working for. But rent can change, like
Yeah.
rent's obviously jacked up because the owner, like in this instance, the owners have a majority shareholder in that property
Mhm.
because they've also got a self-managed super fund.
Yeah.
But they're looking to wind up shortly. So then if they're not owners of the business, well, wouldn't you reduce expenses and reduce the rent? And then that person who's got a
There's a
10%
conflict, right?
stake-
It's already. a
Yeah,
conflict.
like,
Yeah, and so this is your role when they come to you, is to identify these are the issues that you've got within this SMSF. And again, I'll come back to in this space. Sorry, you just wrote a message and I can't see what you've written. Sorry. In this space, ASIC ATO have kicked out a lot of old auditors of SMSFs, and they did a big audit program to get old auditors out in 2023. So that's really interesting as well. There will be more of a focus. There are a lot of SMSFs that have been set up because they're a business owner and they're purchasing their commercial
They're a big thing.
premises, right? But they have no investing experience. They have no understanding. So this is where I get to in terms of it's all well and good for them to be able to purchase that within an SMSF, but they're then held responsible for it, or we are, because even though they're supposed to be, they have no understanding and maybe it wasn't appropriate for them to do it in the first place. So there's all of these things that, long gone are the days where it's, let's just set up an SMSF. I've heard horror stories of people holding $90,000 in an SMSF in cash. because my accountant told me to do it. And then,
Hmm.
divorce happens and then one partner goes, but it has been audited for 6 years, but I'm not responsible, right? So they still don't have that on, like, this is a long time ago, but it's that understanding of just that responsibility. It's not to be taken lightly.
Got a new client walk in the door and they started taking cash out when they're under preservation age to go to the pokies.
Yeah.
I heard about,
In their investments.
So many boxes.
pension fees.
It's my money.
Yeah, no,
That's what she said.
um,
It's so easy.
borrowing
See it in the bank account. What is that?
pay for school fees.
How do you fix that one?
I was saying,
Yeah,
go to your old accountant, fix it and then come back.
Yeah.
It was a mistake.
Your accountants retired. They broke preservation rules, the business failed, the client's situations, she's a new client, her situation's stuck.
yeah, it's
Because
not
the
compliant.
old accountants did all the wrong things.
Yeah.
But she's come to me because she's got inheritance and,
There's a little bit of light.
well, let's not.
So ASIC have issued an information sheet that gives guidance on providing SMSF advice. We do adopt their stance on this. Have a look, please. They had a couple of years ago wanted to increase the minimum, from 200,000 to 500,000. There was a lot of pushback on that. So they have retained it at 200,000. It's
And where did pushback come from?
Good deposit for instance. Good deposit for a property.
I couldn't tell you specifically, but yeah,
Accountants and all of the new ESMSF setups would basically push back on it because it destroys their business. But in theory, you can have the 200K SMSF cheaper than a retail fund.
you could.
Some of the like online, like if you get cash, just cash in it, you basically.
You could, but does
Fee.
do the savings outweigh the benefits?
Well, that's what Host Plus advertise.
Sorry. Does that make up for the fact that they're now held responsible for everything? Like, is that,
Yeah, you've saved $200. You are now responsible for all of these financials and you have zero growth.
yeah,
Don't
Yeah.
pass the test.
yeah, so financial, no, yeah. Sorry, I do have a few things that I really wanted to go through. I knew that I was gonna get stuck again, so sorry. Wholesale clients, they've done a very cursory review of wholesale clients, very, very cursory. They've decided that there's really not much that they're going to change at all. Except to maybe bring in a little bit more about, the clients, but being able to demonstrate that the investors have adequate knowledge and experience. So we already have that test. If you have a look at our wholesale client policy, we also have, the test of who, which category they fall in, what experience they have, as well as a client acknowledgement document. Okay, so for those of you who do have some wholesale clients, though the clients aren't required to, they don't need to receive FSG, SOA, PDS, you still need to have documentation about the advice that you've given, the engagement that you've had, their agreement to fees. Okay, so you still need to demonstrate the relationship. Make sure that you're doing that. If you are the clients that, even though they're wholesale, they're still engaging you as a financial advisor. So they're looking for advice. So make sure that you've got it. It doesn't need to be in the structure of an SOA, but you still need to be able to say, this is what I've recommended. This is why. This is what it's going to cost. These are the consequences. Advisor qualifications. I'm going to wrap this up super quick, but this is, they've now decided that the bachelor degree in financial planning is too narrow. And it's really only relevant to being a financial planner. So they're looking at expanding this again. So this is the current proposal. They're expanding it to be a bachelor degree in any discipline instead of financial advice specific. There are some minimum requirements, ethics, regulations, consumer behaviour, advice process. Still having the professional year, the advisor exam, and ongoing CPD.
comments of business, you know.
Well, this is the thing, this is they're expanding it out, right? So they're going, oh, well, that kind of was a bit silly. So for all of those who have gone out and paid extra to do extra things and to get their qualifications up before the end of this year, it's likely to change again. Which brings me to your qualifications. So you have until currently, so this is a proposal currently. I don't know how this will, they've not indicated how this will affect the requirements for the 1st of January 2026. But we will be doing another audit. ASIC have changed. So you'll notice in some of the media that ASIC are looking at doing an audit on advisors' qualifications and making sure that the ASIC register is, or the financial advisor register reflects it properly. The financial advisor register doesn't actually reflect what they're asking for. And the only way to see it is for us to actually manipulate the system. And they've added more information that we need to confirm for each advisor. It's all behind the scenes, you can't see it. But we will be going through and we will be doing our own audit of that. Make sure, so I might have to come back to you and ask you for different documentation, particularly if you've done anything in the past couple of years for your education. So making sure that we've got those and that they're recorded properly in ASIC.
They should audit the university teachers, because I'm sure they haven't kept up with.
Oh, look, you know what? University of Tasmania, none of their qualifications are approved.
Is that most of the
None of them are approved. So that's really interesting. So we'll have a look at that. We'll come back to you. Compensation scheme of last resort
The
is
good news is for the University of Tasmania, they will be soon.
maybe. Look, you'll see lots and lots of media about this. The FAAA, the AIOFP are really on about this. The proposed levy for 25-26 is $70 million. There is a cap of 20 million in place at the moment. However, that was exceeded last time. They allowed up to 24, I think. That's completely at the minister's discretion. He can.
And he's not there anymore.
So Treasury has actually, once this came out so early, it was this week, they released the actuarial report projecting the levies for 25-26. And off the back of that, Treasury actually announced immediately that they were going to review it. So that'll be interesting. Again, lots of interesting things coming up that I think are interesting. You may not. But
I just don't understand how you can keep penalising people that are doing the right thing.
and this is the thing, there's already a review happening into the Dixon collapse,
It's just,
right? So
what about all the fines going to Westpac? What about all this? Where's it all going?
that's separate to compensation scheme of last
Bullshit.
resort, Matt.
Yeah, but it's bullshit.
So we do have a proposal. We've just paid the ASIC levy, and I'll put this in a document to everybody to help to smooth that out over the year. We're going to do a nominal, it was this amount last year. Compensation scheme of last resort is another one, and that gets paid in October. We don't get these invoices until the month before they're due, by the way, which is why it's always so quick to go, oh, I received the invoice on Wednesday night and your next pay run is Friday, so we're going to make a deduction. We're going to try to smooth this out for you over the year. So we'll put together a bit of a proposal for that for you. Hopefully that will help a lot. We cannot tell you exactly how much it will be, and there is likely to be further in, we'll have to bump it up to make sure that we cover that invoice when we get it, but we'll try to do that for you.
And if there's good news and it goes down,
Then we will deduct it off your dealer fees for that month. You'll get it back. We're not keeping it. That's it from me for today. It's break time. Sorry, I went 5 minutes over. We are going to take a break and we'll be back at 11 a.m. Thanks, guys.
Not even 11 o'clock.
Yes.
Big long day.
Fine.
Yeah, I know. When you're slow, half
Just that's fine.
I do think it's
6 hours.